Hello and welcome. My name is Partho Majumdar. In this video, we will discuss about the call option. Now you would know that options are of two types. One is a call option and another is the put option. In a call option, a security is purchased, whereas in a put option, a security is sold. Now options are essentially a financial contract between a buyer and a seller. So in a call option, when I'm purchasing a security, I need to have a seller who will agree to the purchase in the terms which is mutually agreeable to both the buyer and the seller. Similarly, in a put option, when I'm selling something, I need to find a buyer who will agree to the terms mutually acceptable to both of us so that the sale can take place. Now, another important thing to note is that in an option, we trade in the underlier. The underlier could be a stock, it could be a bond, it could be a commodity. A commodity could be like iron, or it could be gas, or oil, or gold, etc. Or it could be currency like USD to Indian rupees, etc. Now, unlike trading directly in the securities like stocks, bonds, etc., in an option, we treat these securities as underliers. We will see what is the difference between the two through an example. Let us consider stocks as our example to understand difference between trading in stock directly and through an option. Now, the way to buy a stock is I can buy it through an initial public offering or IPO. So when a company announces IPO, I can buy through the IPO. Or if the stock is already trading in the exchange, I can buy through secondary market. That is, I can go through a broker and purchase the stock from the exchange from another seller who is interested in selling the stock. Or there could be other mechanisms like when I'm having a stock of a particular company, the company may announce a bonus share. When a bonus share happens, then I will get some shares without paying any money, but I will get some extra shares to my name. Similarly, the company may split the stock 1:2 or 1:3. So if it is 1:2, for every share that I have in the company, I will have two shares. Now, the important thing to note is that through all these mechanisms, either through IPO or through secondary market or through any of these mechanisms that we discussed, the stock is physically available with me. That is, I am the owner of the stock. The number of stocks that I have purchased from the company. Now, based on that, I will be getting dividend from the company as and when the dividends announced, and I will be having a voting right. That is, a shareholder basically is a part owner of the company. Now, in a option, when I am buying a stock through which is an underlier, I will not have the physical stock with me. So the physical stock is not available to me. However, I'll be trading on that stock using an option. And as a result, since the physical stock is not with me, I am not eligible to get any dividends or voting rights, etc. on that company. The same thing applies for bonds, commodities, etc. Let's understand through another example of a commodity. Now, if I want to buy iron, I can go to the market and buy iron. Now, in that case, the iron that I purchase will be directly in my possession. I will be the owner of that iron. However, if I use that commodity iron as an underlier, I will not be owning the iron, but I can trade on that commodity and make a profit or a loss on that. Having understood what is an option, let us dive deep into call options. Now, call option is a right for the buyer. The buyer has a right here, but not an obligation. So let's understand this through an example. Let's say the buyer says that I want to buy Maruti Suzuki stocks for 5,500 rupees, 100 numbers. So the buyer says I want to buy 100 Maruti Suzuki shares at 5,500 rupees. Now, if he finds a seller who is ready to sell him 100 Maruti Suzuki shares and agrees that he will sell it for 5,500 rupees, then we have the buyer is exercising a call option. Now, in this exercise of the call option, the buyer now has the right to purchase the stock at the price what he has said, that is 5,500 rupees. And also there has to be given time. He should mention that I will buy it within a month, let's say. And within that time, if the buyer exercises his right that he purchases the stock, then the seller is obligated to sell the 100 shares of Maruti Suzuki to the buyer. However, if in case the buyer comes across a situation where he doesn't want to purchase the Maruti Suzuki shares 100 numbers, then he does not have an obligation that he must buy. So in that case, he may just turn away from the trade. So it is a right of the buyer, but not an obligation. So the buyer enters into a contract to buy a stock at a price. This price he fixes, and he has to exercise it within a specified period of time. This price at which he fixes to buy the stock is known as the strike price, and the specified amount of time, let's say he says it's a 1 month expiry, we call it, or we say it's a 1 day expiry. In that case, that expiry date or the period is known as the maturity period or the expiry period. Supposing he makes a call option on 11th of July 2023 and makes a 1 month call option. Then by 11th of August 2023, he has to exercise his option, or he may not exercise his option. Now, for having this facility where he has the right but not an obligation, the buyer pays a premium amount to the seller. The amount what he pays for having this privilege is known as the premium. So you can understand that in a call option, a buyer will enter into a call option contract only when he expects that the stock price will rise. So when a buyer expects that the stock price will rise, he enters into a call option. We will see through an example how this works. Now, you notice that if the price of the stock rises above the stock strike price at or before the maturity, the buyer will exercise his right. If it doesn't, then the buyer will not exercise his right for executing the call option. We will see these two conditions also through an example. In our first example, we will consider that the buyer wants to purchase a call option on a underlier, which is a stock. In our case, I have taken Hero MotoCorp as the example. And what you see here is the intraday chart of Hero MotoCorp on 11th of July 2023. So this is the intraday chart. Now the buyer has been observing the intraday chart of Hero MotoCorp, and he sees that there is a double bottom formation. You can see here the formation is in the shape of a W. So at this point, at time T1, he makes the decision that since it's a double bottom formation, he thinks the stock price is expected to rise. So he makes a call option. So let's say at time T1, he makes the decision and he says that I will make a call option at a strike price of 3102.10. It could be 3103 based etc. Now basically what has to happen is that the price what the buyer proposes, he has to find a seller who will agree for that price. So let's say for example the buyer finds a seller who agrees for a strike price of 3102.10 rupees for the Hero MotoCorp stock at time T1 at this point of time. Now, and the buyer agrees that the contract would be for a 1 day expiry. That is, within the end of the day, the contract would expire. So this is the situation. The last condition what the buyer and the seller agree is that the premium what the buyer would give to the seller is ₹1 per share. So this forms the entire agreement. That is, what is the strike price, what is the expiry date, and what is the premium what is agreed between them. Now the stock price keeps moving from this point. It keeps moving, and at time T2, the buyer decides that I will sell the stock. Now, normally in a double bottom formation, this is the point where the double bottom formation peaks, and this is the lowest point of the double bottom formation. So this height, what we get, we normally expect that the stock will raise by the same amount. If this is H, then from this point it will raise by the same amount, that is H. So this is the normal expectation of this particular stock. So the buyer had a consideration that the stock can rise up to 3110.10. However, at time T2, when the stock price is 3109.85, the buyer decides that he will execute his call option. So when he executes his call option, the seller is obligated to sell because he has entered into a call option. So the seller has to sell at the price what the buyer has set for him, that is 3102.10. However, the current market price is 3109.85. So what happens is that when this trade takes place, the buyer makes a profit. How much profit? He makes a profit of the current market price minus the strike price minus the premium, that is in this case rupees 6.75. So this is the profit what the buyer makes per share. So the total profit what the buyer makes is into how many ever shares he has agreed in the call option. So in this case, I'm considering 100 shares, so it will be 6750 rupees will be the profit of the buyer. Now call options, it always happens in a lot. The lot size normally is 100, it can be others also, it can be 1000 also, but normally the lot size is 100. So in this case, you notice that since the market price has risen, the buyer makes a profit. And even though the seller will be making a loss, he is obligated, he must sell at the strike price that is quoted by the buyer. One more thing we need to consider is that we have only considered the prices at the buyer and the seller end, but normally there will be brokers through which the trade has to take place. It can be a bank or it can be a brokerage house or whatever it is, but a broker is always going to be present. The brokers will always charge a brokerage fee, and the brokerage fee will be charged from both the buyer and the seller. Now let us consider one more example. This is also a very common usage of the call option. Supposing airlines, which requires to purchase airlines fuels for its operations, finds out that the price of the airline fuel is going to increase because maybe because of studying the price of crude oil, they think that the crude oil price will increase, and as a result, if the crude oil price increases, the airline fuel price will also increase. So with this speculation, what the airlines wants to do is that he wants to prevent his losses from the increase in the price of the airline's fuel. Let's say that the present price of the crude oil is $100 per barrel. So what the airlines is basically considering is that he wants to buy a call option with the commodity crude oil being the underlier, and he wants to save his position. So he says that the current price of the crude oil is $100 per barrel. The airlines is thinking that the crude oil price will increase. So what the airlines speculates is that he makes a call option saying that I will buy crude oil at $102 per barrel, and I am ready to pay a premium of $2 per barrel. So with this condition, and of course there has to be a third condition that this has to have an expiry. Take for consideration that the expiry is 1 month. Okay. Now he finds a seller who is ready for this condition that the strike price would be $102 per barrel and the premium would be $2 per barrel and the expiry would be for 1 month. Now let's say within this 1 month, the price of the crude oil rises to $110 per barrel. This is as happening as per the airline's expectation. Under this circumstance, the airlines will exercise its call option. What will happen is that the current market price is $110, the strike price was $102, so difference is $8, and the airlines paid a premium of $2. So the total profit per barrel for the airlines is $6. The airlines had purchased 10,000 barrels, so the total profit of the airlines is $60,000. Now, what the airlines can do is, having earned $60,000 by exercising this call option on crude oil, the airlines can now utilize this money to offset the increased price of the airline's fuel, which it has to purchase. Carrying on with the same example, let us consider that everything doesn't go according to the way the airlines thinks. Let's say that the market price of the crude oil raises only to $103 per barrel, at the expiry date. Now the airlines has a choice whether to exercise the call option or to not exercise the call option. So what the airlines has basically done is that he has stated a strike price of $102 and he has agreed for a premium of $2. So the total cost per barrel would be $104 for the airline. Now, if the airlines exercises the call option, the market price 103 minus 102 minus 2 would make a loss of $1 per barrel. And he has purchased $10,000, so the total loss would be $10,000 for the airlines. This is if he exercises the call option. If he does not exercise the call option, then the airlines will have to bear the premium price what it has agreed for, that is $2 per barrel, and the total loss will be $20,000. So in this case, you notice that the airlines is better off exercising the call option and minimizing its loss to a $10,000 loss. Let's consider a third scenario in the same example. Let's say at the maturity, the price of the crude oil is $101 per barrel. In this case, like we had already calculated, the airline's cost is coming to $104 per barrel. So if the airlines exercises the call option, he will have a loss of $3 per barrel or a total loss of $30,000. In this case, the airlines will not exercise the call option. Instead, he will just let go and pay the premium, the cost of which will come to $20,000. Now, the important thing to notice from these three examples is that when a call option is exercised, the profits can be unlimited. If the price rises according to what is expected, the profits can be unlimited. However, the loss is restricted to the premium amount what is agreed in the call option. The loss will not be more than the premium amount what has to be paid for the call option. Here we see the airlines example in the form of a chart. So here the airlines agreed for a strike price of $102 per barrel. So here it is. And he agreed for a premium of $2. So the airlines is here at the time the call was made. Now, if the price of the crude oil increases, then at this point the airlines breaks even. That is at $104 per barrel, the airlines breaks even. He neither makes a profit nor a loss. However, if the price rises further, then the airlines makes a profit. But notice that at the maximum, the airlines can make a loss, which is at $2 per barrel. So we see that in the case of a call option, it is unlimited profit. Now, the important thing to note here is unlimited profit for the buyer. But limited loss for the buyer. The opposite holds true for the seller. For the seller, it is unlimited loss and limited profit. So, the buyer will always exercise the call option when the market price is greater than the strike price. That brings us to the end of this discussion. I hope you enjoyed it as much as I enjoyed recording it. Thanks for listening.